Hello. This video is on audit planning and fieldwork. What does planning mean? Planning means strategy that involves expected nature, timing, and extent on audit. Planning is important because it can avoid misunderstanding. Planning also minimizes legal liability. Also, it conducts an audit in efficient and timely manner. It also keeps audit cost at reasonable minimum level. Firstly, we are going to look onto pre-plan, client's acceptance. These are the procedures regarding new client. The first procedure is to obtain and review information about client's business and industry. It will help the auditor understand the nature, type and need of the client. The second procedure is reviewing client's financial report. It provides the auditor the overall view of client's financial activity. Next, inquiring bankers, lawyers and other resources about the client's reputation. The last one is communicating with the preceding auditor. Moving on to continue client. These are the procedures for prospective clients. 1. Integrity of those in charge with governance. 2. Obtaining and reviewing financial information. 3. Information from third party that is legal advisors. 4. Communication with predecessor auditor. And 5. Evaluate audit's firm independence and ability to service the client's requirement. Next, procedures for evaluating existing clients. The first 5 procedures are the same with procedures for evaluating prospective clients. These are the additional circumstances. First is major change in management, director, ownership, legal advisors, financial condition, litigation and nature of client's business. Second is scope of engagement. Third is business risk. Next part is the scope of audit work. What is an engagement letter? It is the agreement letters by auditor's firm to his client before the commencement of his assignment. The engagement letter's purpose is to confirm the acceptance of appointment and form of audit report. Next, it is to clearly defines the auditor's responsibilities and objectives, also the scope of audit. The engagement letter is needed because it will protect us from legal liability. And lastly, it is to avoid misunderstanding between auditor and client. Engagement letters' content are objective of the audit, financial statement, scope of the audit, responsibilities of client's management, auditor's right to access, form of reports, deadlines and audit fees. Auditors do not need to send letter each period. However, there are reasons for the auditor to send a new letter, such as if there is any indication that the client misunderstands the objective and scope of audit. Also, if there is any revised or special terms on the engagement. Next, if there is any recent change of senior management, board of directors, or any legal requirements. Development of the audit strategy. These are the factors auditors need to consider when designing audit strategy. Identify characteristics of engagement. The reporting objectives, results of preliminary activities from other relevant engagement. Ascertaining the nature, timing and extent of resources. These are 4 broad areas of a client's business and its environment: industry conditions, regulatory environment and other external factors, nature of entity, objectives and strategies and related business risks, measurement and review of financial statements. Fraud and error. Fraud means wrongful or criminal deception intended to result in financial or personal gain. Error means a transaction wrongly recorded but did not have any intention to do it. Moving on to scope of audit work. Setting audit objectives. Management assertion refers to expressed or implied representations by management and are reflected in financial statements. In other words, assertion means strong statement. There are 3 categories of assertions. First, assertions about classes of transactions and events for the period under audit. Next, assertions about account balances at the period end. Third, assertions about presentation and disclosure. The first category of assertions is about classes of transactions and events for the period under audit, which consists of occurrence, completeness, accuracy, cutoff, classification. The second category is assertions about account balances at the period end, which consists of existence, rights and obligations, completeness, valuation and allocation. The third category, that is assertions about presentation and disclosure, consists of occurrence and rights and obligations, completeness, classification and understandability, accuracy and valuation. Moving on to the next section, The preliminary analytical procedures. The purpose of preliminary analytical procedures are to assist in planning the nature, timing, and extent of audit procedures, to identify potential errors, to determine areas that require detailed checking and substantive tests. Moving on to materiality. It is a criterion for determining the items require attention and detail examination. ISA 320 states that information is material if its omission or misstatement could influence the economic decisions of users. There are two natures of materiality, and we need to consider both the quantitative and qualitative nature. Examples of qualitative aspects that affect materiality are wrong use of accounting policy, misstatements, fraud. Common bases in judging materiality in terms of quantitative are total assets, total revenue, gross profit. Audit risk. Audit risk is the risk that the auditor gives an unmodified or unqualified audit opinion when the financial report is materially misstated. There are two types of risks faced by an auditor. The first one is auditor's business risk. Examples are exposure to loss or injury from litigation, adverse publicity, or other events arising in connection with financial statements audited. This risk cannot be directly controlled. The second risk is audit risk. This is a risk that auditor gives inappropriate audit opinion on financial statements that are materially misstated. Audit risk can be directly controlled. There are three components of audit risk, that are inherent risk, control risk, and detection risk. Inherent risk is the susceptibility of an assertion to material misstatements in the financial statement in the absence of internal control. It is also known as auditee risk. Inherent risk can be assessed through knowledge of client's business during first and recurring audit, management integrity, and client's knowledge of accounting standards. Control risk is a risk that material misstatements will not be prevented or detected on a timely basis. Control risk can be assessed through segregation of duties and inherent limitation of internal control. Detection risk is a risk that substantive audit procedures performed will not detect a material misstatements that exists in an account balances or class of transaction. Detection risk can be assessed through decide on nature, timing, and extent. Here are the steps to minimize audit risk. Plan and delegate audit with due care. Avoid misunderstanding with clients. Use audit manual. Audit evidence are properly documented. Audit fee should be based on work done. Thank you for watching.